Hello there, welcome to your weekly macro roundup for February 14th, 2026. In the United States, Wall Street started the week on edge but found some footing after relatively tame inflation data. Headline inflation cooled, and bond yields fell. However, weakness in major tech names capped broader equity gains, a reminder that leadership remains narrow. Labor market signals, mixed but resilient. The U.S. labor market began the year stronger than expected. Employers added 130,000 jobs last month. The unemployment rate fell to 4.3%. Participation increased, a positive structural sign. But not all data aligned. The ADP report showed weaker private job gains. Small business confidence slipped for the first time in 3 months. And retail sales unexpectedly stalled in December, suggesting consumer momentum may be softening. Meanwhile, sales of previously owned homes dropped 8.4% in January, the steepest fall in nearly 4 years, partly impacted by severe winter storms. Consumer pressure building data from the Bureau of Labor Statistics shows median household spending reached $78,535 in 2024, roughly $6,545 per month. Housing and transportation alone account for over half of total expenditures. After adding food and healthcare, less than 30% of income remains for everything else. That squeeze matters, especially if borrowing costs stay elevated. Adding to concerns, the New York Fed reported household loan default rates rising to their highest level in nearly a decade. Inflation and Fed expectations core inflation has fallen to its slowest pace since 2021. Headline CPI came in better than expected. Politically sensitive categories, gasoline, beef, eggs, declined. But shelter costs continued rising, airfares jumped, and tariffs appear to be affecting prices in apparel, computers, and smart devices. Markets are now recalibrating rate cut expectations. Fed futures are pricing nearly a 50% probability of a cut as early as April, Jerome Powell's final meeting as chair. A June cut, when Kevin Warsh is expected to take over, is now fully priced in. At the same time, JP Morgan's annual survey suggests geopolitics will be the biggest volatility driver this year, with AI disruption also high on traders' watch lists. On fiscal and trade developments, the Congressional Budget Office increased its deficit projections by $1.4 trillion over the coming decade, driven by tax cuts and reduced immigration. Commerce Secretary Rutnick argued the dollar has been artificially inflated due to foreign manipulation, predicting a manufacturing rebound in 2026. Meanwhile, the U.S. government is preparing a general license allowing companies to pump oil in Venezuela, signaling a partial easing of sanctions. And White House trade advisor Peter Navarro stated that the USMCA contains significant flaws and will be reassessed in July, raising new uncertainty for North American trade. Interestingly, equity flows tell a broader story. Developed markets outside the U.S. have attracted over $100 billion this year, compared to just $25 billion into U.S. funds. The dollar index is projected to fall 10% from late 2024 levels, and the S&P 500 has lagged non-U.S. indices. Global capital may be quietly rotating. Elsewhere in China, China continues navigating uneven recovery dynamics. Vice Finance Minister Liao Min pledged further economic opening and a shift toward more demand-driven growth. There's renewed discussion about opening the capital account, with experts suggesting outflow risks are manageable. But the data paints a cautious picture. Consumer inflation rose just 0.2% year-over-year in January, down sharply from December. Producer prices fell 1.4%, extending deflationary pressures. Domestic demand remains weak. The People's Bank of China injected $86 billion via repurchase agreements ahead of Lunar New Year liquidity demand and reiterated its moderately loose policy stance. At the same time, China finalized dairy import tariffs on EU products at up to 12%. Cross-border e-commerce exporters will receive tax refunds through 2027. Outbound M&A surged in January, reaching nearly $12 billion, the strongest start since 2017. The yuan has strengthened significantly, breaking below 7 per dollar and approaching 6.90. Beijing appears increasingly comfortable with a stronger currency. And in the tech space, OpenAI warned U.S. lawmakers that Chinese startup DeepSeek is attempting to replicate leading AI models, highlighting rising AI competition between the two economies. In Europe, policymakers are navigating currency strength and trade tension. ECB President Christine Lagarde reiterated that inflation should stabilize at the 2% target in the medium term, emphasizing a data-dependent, meeting-by-meeting approach. The strong euro remains a political concern, potentially dampening inflation further. The ECB is also exploring broader access to euro liquidity backstop facilities to strengthen monetary sovereignty and prevent funding disruptions. Meanwhile, the European Parliament is advancing a trade deal with the US, including a sunset clause set for 2028. Tariffs on steel-related products could fall from 50% to 15%, depending on compliance. The ECB has also urged EU leaders to take urgent collective action, proposing a savings and investment union, a digital euro, deeper single market integration, innovation promotion, and regulatory simplification. Structural reform remains front and center. Over in Canada, trade uncertainty dominates Canada's outlook. President Trump is reportedly questioning continued participation in the USMCA. While no formal move has been announced, even rhetorical uncertainty raises risk premiums. In Washington, the House narrowly passed a resolution disapproving of tariffs on Canada, a rare bipartisan rebuke. The Bank of Canada noted that U.S. policy uncertainty makes forecasting the next rate move increasingly difficult. Meanwhile, Canadian cardholder spending softened in January, partly due to severe winter weather but also post-holiday fatigue. On the energy front, Canada continues pushing carbon capture investments in Alberta's oil sands, even as U.S. environmental policies shift in the opposite direction. In the United Kingdom, the economy barely grew in Q4 2025, expanding just 0.1%. Services stagnated. Construction saw its largest drop in 4 years. Business investment fell nearly 3%, reflecting tax uncertainty and hesitancy ahead of the November budget. However, manufacturing provided a modest lift. For the full year, the UK grew 1.3%, outperforming France, Italy, and Germany, though per capita, growth remains weak. The Bank of England's deputy governor suggested another 25 basis point cut could occur before the end of April. Wage growth for newly hired permanent staff saw its biggest rise in nearly 18 months, while London property price expectations turned positive for the first time in over a year. The UK remains fragile, but not collapsing. Finally, in Japan, the week's political highlight came from Japan. Prime Minister Sanae Takaichi secured a commanding election victory, granting her party a supermajority in the lower house. Markets responded positively. Japanese equities surged. The yen strengthened. Government bond markets stabilized. Takaichi now faces the more difficult challenge, convincing capital markets of fiscal discipline while pursuing stimulus measures. Japan is also accelerating discussions with the United States on its $550 billion investment package aimed at reducing tariff pressures and strengthening economic ties. The next test will be how markets respond to fiscal expansion alongside expected monetary normalization. In closing, this week highlighted a world economy at an inflection point. Inflation is easing but not gone. Labor markets remain resilient but uneven. Fiscal pressures are mounting, trade uncertainty is resurfacing, and capital is gradually rotating across regions. Next week's focus turns to flash PMIs across the US, UK, and Eurozone, Japan's preliminary Q4 GDP, and fresh CPI readings from the UK and Canada. Thanks for watching the wrap-up this week. If you enjoyed it, remember to like, share, and subscribe.